Hello and welcome to the Daily Brief Show. I'm your host Anurag Bansal. Today is Wednesday, the 11th of September, and I have three very interesting stories for you. In the first story today, I'll talk about Ather's upcoming IPO and its DRHP. In the second story today, I'll talk about how India's diamond industry is in bad problems. And in the third one, I'll talk about how front running is a big problem for the markets. So let's begin. Look, until Ola Electric arrived in the scene, Ather Electric was arguably the poster child of two-wheeler electric vehicles in India. The reason why this is relevant today is because Ather filed for its IPO and there is a lot of interesting insights that we can learn from it. This spans both Ather and the Indian two-wheeler industry. Now, Ather is planning to raise about 300 crore rupees through a mix of fresh issue of shares and offer for sale. The price bands are not known yet. Now, before I get into talking about the industry as a whole, let me give you some numbers about Ather. In the financial year 2024, Ather reported revenues of about 1,700 crores and losses of about 1,000 crores. In the previous financial year, the revenues were about the same, but losses were about 860 crores. This year, the increase in losses was due to an exception. It was due to the reduction of FAME subsidies by the government. If you don't know much about EV FAME subsidies, I discussed this on our episode on September 6th, so do check it out. To compare with Ather, Ola Electric in FY 2024 did revenues of about 5,200 crores and losses of 1,580 crores. In FY 2023, Ola did revenues of about 2,600 crores and losses of 1,470 crores. So clearly, Ola is much bigger than Ather by a mile. Now, in terms of market share, Ola has about a 35% share in the market, while TVS follows behind with a share of 19%. Ather, on the other hand, commands about 12% share in the EV two-wheeler market. Now, while we're at it, let's also take a very quick look at Ather and Ola Electric's sales numbers. In FY24, Ather sold 1.1 lakh scooters, while Ola sold 3.3 lakh scooters. And this, as you can imagine, is quite a big gap. But moving on, let me give you some interesting insights about the overall two-wheeler market that will help you get a better sense of the opportunity size for Ather and also the challenges. I'll break it down into 6 points so that it's much easier for you to understand. First, 53% of Indian households own a two-wheeler. But the problem with this total is that it hides a massive variation in ownership across different income levels. Among some of the poorest households that earn about 1.25 lakhs a year, 34% of households own a two-wheeler. This keeps increasing with income levels hitting 75% among rich households that typically own luxury bikes. Second, by volume, 73% of all vehicles sold are two-wheelers in India. Third one is very interesting. Between FY 2019 and FY 2024, the sale of petrol two-wheelers was a negative 4%, while EV bikes grew by 100%. Now, obviously, the base was very different, but the growth is still very, very encouraging. Fourth, in FY 2024, 9.4 lakh electric two-wheelers were sold. For your comparison, this number was just 30,000 in 2019, which is not bad as a growth number at all. The total penetration of electric two-wheelers is at about 6 to 7% right now. Fifth, the two-wheeler financing penetration currently stands at about 50 to 55% of the total bikes sold in India. This has increased from about 40% in 2019. Now, the increased financing penetration is crucial for the increase in sales for any vehicle, let alone two-wheelers or EVs. Number 6, as of 2024, there were 16,300 public charging stations, which are very crucial for the adoption of electric vehicles. What is unclear from this data is how many charging stations were for two-wheelers and how many were for cars. Also, it's still a little unknown if all of these 16,300 charging stations are operational as of now. But ultimately, all said and done, the math for an electric two-wheeler versus a petrol two-wheeler all depends on the total cost of ownership. In other and simple words, does it financially make sense to own an electric bike as opposed to a petrol bike? As per Ather's DRHP, if you assume an annual usage of about 8,000 kilometers, a two-wheeler is about 37% cheaper than a petrol bike. With subsidies, it was 52% cheaper, by the way. They are projecting that by 2031, this will be 52% cheaper compared to petrol bikes. Now, when you look at acquisition cost or the ex-showroom price, the total acquisition cost of an electric two-wheeler was about 40% higher than that of a petrol bike. But Ather expects this gap to shrink very quickly. Now, this is very much possible because with increased adoption, there will definitely be increased economies of scales and manufacturers can pass on these benefits to consumers. There's also the fact that EV battery technologies are advancing at a very, very fast pace. So all of this is good news for both the planet and us as consumers. Both Ola and Ather are currently investing heavily in order to ramp up production. Ather is investing over 6,000 crores to build a plant in Hosur and about 2,000 crores to build a plant in Maharashtra. Even Ola is investing very heavily and has committed to invest 6 to 7,000 crores to set up plants in Tamil Nadu, including Hosur. It's very interesting that Tamil Nadu is now becoming the preferred manufacturing location for electric vehicle manufacturers. This is largely because of lower tax. The Vietnamese EV giant VinFast is also setting up a plant in Tamil Nadu. This is a story we'd spoken about a couple of months back. But if we talk about the competition in this space, this segment is highly concentrated right now and only a few players cater to the entire segment. In 2019, a few players like Hero Electric and Okinawa completely dominated the market with more than 80% share. Over the years, new players and legacy players like TVS and Bajaj have launched EV two-wheelers. Today, Bajaj has the same EV market share as Ather. Moving on to the second story, I'll talk about how India's diamond industry is really in deep distress. Look, the Indian diamond industry is currently facing some really bad times. Considering I've spoken about natural versus lab-grown diamonds on this show very recently, I thought this would be very relevant and important information for all of us to know. While speaking to CNBC recently, the chairman of the Indian Diamond Institute, Dinesh Navadia, recently warned that the diamond industry is at a breaking point. What does this mean and what's happening exactly? Let me explain very simply. First, diamond exports have been falling by about 30% as compared to the previous year. And second, the prices for rough diamond, which is the natural, uncut and unpolished form of a diamond, have been falling for about 18 months now. Now, you might be wondering what is exactly causing this distress? Look, there are multiple factors, and I'll explain. First, the G7 ban on Russian diamonds. Look, in December 2023, the G7 group of rich countries including US, UK, Germany, etc. imposed sanctions on import of non-industrial diamonds from Russia. This move is a part of a long list of economic sanctions posted in the wake of Russia's invasion of Ukraine. Now, Russia is the largest exporter of rough diamonds, which generated about $3.5 billion for the country. The EU wants to cut off this source as one of the many sources of funding that Russia is using to fund this war. India also used to source about 30% of its rough diamonds from Russia and then exported them to the rest of the world. As part of the sanctions, the G7 countries included a ban on Russian diamonds produced even in other countries like India, and they also mandated a full traceability system for diamond imports. This affected Indian diamond trees who were already struggling. As part of the traceability requirement, the European Union proposed to set up traceability facilities in Belgium, which would mean a significant increase in cost for Indian diamond exports. But after a pushback, this requirement has now been postponed to March 2025, but Indian diamond exporters are still not out of trouble. The second reason is that US demand has reduced sharply. Look, the US is a major market for Indian diamonds and it imports more diamonds from India than from any other country. But US demand has dropped significantly from 2021 and 2022. In a way, you could say that US interest rates remaining at multi-decade highs has changed consumer purchase decisions even as overall consumer spending has remained high. The other factor that seems to be affecting the demand for natural diamonds in the US is the shift in some segments like the bridal segments towards synthetic diamonds. In fact, 50% of engagement ring purchases in 2024 in this segment were synthetic diamonds. This has further led to a drop in diamond imports by the US, and India is the eventual loser. The third reason is the Chinese economy slowing down. China is a massive market for luxury goods. To give you context, China accounts for about 25% of the entire world's luxury spending. But over the last few years, China's GDP growth has significantly slowed down. Weak consumer demand and the long problems in its real estate and construction sector, which by the way makes up over 30% of China's GDP, has slowed down economic growth. In fact, there are deflationary pressures that seem to be building up as consumers just refuse to spend in China. China is also very popularly known for its savings culture and has one of the highest savings rate in the entire world. The big factor that seems to be leading to conservativeness among the Chinese consumer is the after effects of COVID-19. While most part of the world has had some government stimulus that helped reduce the intensity of the economic shocks due to COVID, China did absolutely nothing in a manner of speaking. In fact, it had one of the most severe lockdown policies across the entire world, and this seems to have pushed the already conservative conservative Chinese consumers to save more as precaution, and this is rippling out across the entire economy in the form of reduced consumption. In fact, there is also evidence that Chinese consumers are paying down their mortgage debt and consumer debt instead of spending. The result of all of this was that Chinese diamond imports in FY 22-23 fell by almost 30%, which significantly impacted India because China is a big export market for us. The fourth reason is lab-grown diamonds. Look, in recent years, the popularity of lab-grown diamonds has grown a lot. Even though it still represents a very small fraction of the overall diamond market, lab-grown diamonds are appealing as a cost-effective and ethically alternative solution to natural diamonds. It is particularly gaining more popularity amongst younger consumers who are more conscious about sustainability and their budget. One very interesting and important shift that is happening is the rising price gap between natural diamonds and lab-grown diamonds. Even though there is no good data point to quantify this change, the growing price difference is expected to add more and more pressure on the natural diamond industry. But to sum things up, the collapse in demand from China and the US, the sanctions on Russian diamonds, high inventories of unsold diamonds, etc. have led to serious stress amongst Indian diamond exporters. The high inventory problem is particularly more problematic because diamond industry typically relies on debt. The continued interest burden as sales remain depressed is pushing these diamond industry people to the brink now. Things are getting so difficult now that some industry bodies are even recommending a temporary freeze on imports until inventories reduce. It's gotten to a point where people working in the diamond industry have seen wage cuts of up to 50%. Many factories in Surat, which is by the way the heart of India's diamond industry, are now operating only 2 days a week. Moving on to the third and the final story of the day, let me talk about how big the front-running problem is in the Indian stock market. Look, recently the Enforcement Directorate or ED registered a case under the Foreign Exchange Management Act against Viresh Joshi, who's the former dealer at Axis Mutual Fund. The ED is conducting searches at premises linked to Joshi in a connection with the Forex violation case. If you followed the news, you would remember that Joshi was caught by SEBI in a front-running probe. But before I get into the details, let me first break down what exactly a front running actually means. Look, front running is an illegal practice where someone with inside knowledge of a large pending transaction uses that information in order to make trades for their own benefits. In the case of a mutual fund, it typically involves a fund manager or a dealer buying or selling stocks just before their fund makes a large trade. This eventually makes them profit from the price movement that is caused by the fund's action. Now, the Axis Mutual Fund case is a very good example of how damaging front running can actually be. SEBI's investigation found that Viresh Joshi, along with some others, had allegedly been front running trades of Axis Mutual Fund for many months. They used a network of accounts to execute trades based on non-public information about Axis Mutual Fund's upcoming large orders. This scheme reportedly generated over 30 crore rupees in illegal profits. Now, the problem is that the impact of such actions is not just monetary. It also ruins investors' trust in mutual funds, which in a manner of speaking are supposed to be managed by professionals acting in the best interest of their clients. If and when mutual fund employees abuse their position for personal gain, it undermines the entire system. But the Axis case is not an isolated incident. Just last week, the Wall Street Journal reported a whistleblower complaint saying that Bank of America's Asia division engaged in very similar practices. According to the WSJ or Wall Street Journal, the complaint claims that bankers in BofA's Mumbai office shared non-public information with investors before the bank sold hundreds of millions of dollars of stock. Now, this allegedly allowed certain investors to potentially front-run these large trades. The WSJ report specifically mentions two transactions where this front-running occurred. One involved a $200 million sale of stock for a subsidiary of Indian conglomerate Aditya Birla and financial firm Sun Life. The other one was roughly a $500 million initial public offering for SoftBank-backed retailer First Cry. Now, these allegations, if they are proven true, would represent a serious breach of market integrity. These recent cases are part of a larger worrying trend. Over the past few years, we have seen front-running allegations surface against several major players in India's financial markets. Back in 2022, the Life Insurance Corporation of India or LIC faced some scrutiny when SEBI issued an order against 5 entities involved in a front-running scheme related to LIC's trades. The regulator found out that these entities had made gains amounting to 2.44 crore rupees through their front-running activities. As a more recent example, Quant Mutual Fund had come under investigation and SEBI conducted search and seizure operations at their offices in Mumbai and Hyderabad. SEBI's own data confirms the growing scale of this problem. According to their latest annual report, the number of insider trading investigations taken up by the regulator more than doubled from 85 in 22-23 to 175 in 2023-2024. What is even more surprising is the surge in front-running cases, which jumped from 24 to 83 in this same period of time, which is an increase of over 245%. Now, the frequency and scale of these cases have prompted SEBI to take some serious action. The regulator has proposed expanding the list of connected persons in its insider trading regulations. This would broaden the scope of individuals who could be held accountable for such violations. In a consultation paper released in July, SEBI outlined its plans to widen the net of who's considered a connected person. These proposed changes would include more family members, business associates, and individuals with close financial ties to those already connected. This is to capture those who might have access to insider information through their relationships, even if they do not have direct connections to the company. SEBI's new proposal also looks to align the definition of a relative with the broader one that is used in the Income Tax Act. This will potentially bring more family members under scrutiny in these cases. The regulator's larger goal here is to close all loopholes and make it very, very hard for insider information to be misused ever again. This proposal, however, has faced some serious criticism. Sandeep Parekh, who is a very noted securities lawyer, argued that the expanded definition could potentially criminalize innocent individuals as well. In an article, Parekh warned that the proposed changes might lead to a situation with 100% false positives and 100% false negatives. This means it could implicate innocent people while still failing to catch the actual wrongdoers. Now, Parekh's concerns are very fair and they highlight a very delicate balance that regulators need to strike here. On one hand, there is a very clear need to crack down on front-running and other forms of market abuse. But on the other hand, overly broad regulations risk creating unintended consequences and potentially shifting legitimate market activity. In response to all these concerns, the Association of Mutual Funds in India, or AMFI, recently unveiled new standards to prevent front-running and market abuse at asset management companies. AMFI's new framework includes stricter surveillance measures, enhanced alert systems, and tighter controls on personal transactions of key employees. Now, these standards will be implemented in phases. It will start with large equity funds in November 2024 and will gradually expand to cover all types of funds by August 2025. These measures aim to create a more robust system for detecting and preventing market abuse, thereby enhancing investor protection and market integrity. Now, while these steps are definitely great, their effectiveness will definitely depend on implementation by fund houses and the ongoing oversight from regulators. That's all the news and stories I have for you today. I hope you found this episode valuable. I'll see you tomorrow. Take care and goodbye.